Hello and welcome to this week's lecture where we'll be discussing the behavior of firms. In particular, we'll be focusing on production. My name is Mike Wenz and I'll be guiding you through the slides. When we think about supply and demand, we think about consumers as representing the demand side of the equation, and we think about producers as representing the supply side of our supply and demand model. So firms that are the producers of goods and services. And we begin with the assumption that firms' goals is to maximize profits. This is probably not a perfect approximation for all firms. For example, nonprofit organizations or government organizations that produce goods and services, but it's probably a pretty good place to start when we think about private firms that think about producing goods and services to sell in the market. Profit maximization is to essentially maximize the return on the effort that they put into the production of these goods and services. We define profits as the difference between the revenue that the firm takes in and the opportunity cost of using resources in the production of goods and services. So revenue then represents the amount a firm receives from the sale of its output. And cost represents the market value of the inputs that a firm uses in production. Firms collect revenues, and if we think about a demand curve and we think about a firm that's able to sell 1,000 units of its output at $4 a piece, we can show you this as the rectangular space under the demand curve at that point. So this firm's revenue here is $4 times 1,000 units, or $4,000. And this is a firm that's selling gas, 1,000 gallons of gas at $4 a piece, and the area of that rectangle represents their $4,000 in revenues. When we think about costs, it's important to include two kinds of costs. The first one are implicit costs, and the second one are explicit costs. Explicit costs are what accountants think of. These are the things that involve outlays of money. So if we pay wages to our employees, these are explicit costs. When we buy supplies, when we rent space for our facility, these are explicit costs. They involve an outlay of money. Implicit costs include other foregone opportunities. So these are things that do not involve outlays of money, but they're still important for economic decision making. These things include the value of the owner's time, the opportunity cost of capital, the money I could have earned if I had left my money in the bank or in the stock market rather than using it to buy equipment to start a business. The extra bedroom that I don't rent out because I use it for my home office. These are opportunity costs that I don't necessarily involve an outlay of money, but they still represent costs to my business, resources that are used in the business. The value of my time working at running the business is time that I can't spend doing other things, and those things are true costs of business, even though I don't outlay any cash for them. Opportunity costs include both implicit and explicit costs, and whenever economists think of costs, they always think of opportunity cost, or should always think of opportunity cost. And opportunity cost includes both parts, both the implicit and the explicit parts. When we think about profit, accountants and economists have a different conceptualization of profit. Accounting profit is revenue minus explicit costs. So these are the dollars in minus the dollars going out. But to an economist, the economist wants to consider both explicit and implicit costs. To an economist, profit is revenue minus explicit costs and also minus implicit costs. And neither is right or wrong, they're just different. Accountants are usually interested in keeping track of accounts or figuring how much tax people owe or things like that. When we think about the goal of economists is to think about choices. And when we think about the choices we want to make, the key thing to focus on is economic profit. The right thing for economists to think about when they think about choices is economic profit. A positive accounting profit means that your revenues exceed your explicit costs. The dollars coming in exceed the dollars going out. Economic profit, if you have a positive economic profit, it means you did better than your next best alternative. Even $1 in positive economic profit reflects the fact that you made the right choice. A negative economic profit means you could have made a better choice with what to do with your time and your resources. So here's an example. Consider whether or not you should open your own business, and your next best alternative is to just continue working at your job and earning a $50,000 salary. Option B, we would open a landscaping business. We quit our job. We give up the $50,000 in wages. We withdraw $20,000 from our savings account to buy equipment, to buy lawnmowers and machines and other things that we need to run a business. And this costs us foregone interest at 5%. We used to have $20,000 in our savings account earning 5% per year. But when we withdraw it to buy the lawnmowers, this costs us $1,000 per year. So let's take a look at how an economist and an accountant would view things differently. Let's assume that our landscaping business earns $100,000 in revenues and incurs $15,000 in costs for supply and $40,000 in wages for our employees. An accountant would look at this business and say that it made $45,000 per year. So was it a good decision? Was it a good choice? And an economist would look at this and say, well, you gave up $50,000 in salary to do it, and you also lost $1,000 in interest payments, which means your economic profit is minus $6,000. So the economist would say, no, you're better off keeping your current job and earning the $50,000 in salary. So at the end of the day, the accountant would tell you you made $45,000 in profits. The economist would tell you you lost $60,000 in economic profits. There's also one more thing that's worth noting. The withdrawal of $20,000 in savings to buy equipment is not an economic cost. We're essentially trading one asset, money in our bank account, for another asset, the equipment it takes to run the business. These are things that we still own and have some market value. We could presumably sell the lawnmowers to somebody else. But we should note that if there's depreciation, then that would be an appropriate cost for an economist to include as well. But the act of taking $20,000 in savings and using it to buy an asset for the business, that in and of itself is not an economic cost. The economic cost is the foregone interest, the foregone opportunity to earn interest on those $20,000 that we took out of our savings account.